There is a number on your screen right now, and if you are using that number to understand the silver market, you are reading the wrong story entirely. I'm OG Peter. This is SilverDispatch. And today, we are going to walk through something that the mainstream financial press has not connected properly. A sequence of events, data points, and institutional moves that, taken together, paint a picture that the spot price of silver simply does not reflect. Before we go any further, drop a comment right now. Tell me where you're watching from and how you're currently holding silver. I want to know who's in the room today. I read every single one. Now, let's establish the foundation. For the past 18 consecutive months, institutional-grade participants have been demanding physical delivery of silver on the COMEX exchange, not rolling contracts forward, not settling in cash, not taking paper exposure, taking metal, actual physical silver loaded onto trucks and removed from the vaults of Lower Manhattan. The total COMEX silver inventory has declined by 31% since October 2025. The registered pool, the metal immediately available to back futures contracts, has sat below its 6-month average for an extended period. The coverage ratio, which tells you what percentage of outstanding paper contracts could actually be fulfilled with real metal at this moment, has been below the 15% stress threshold for 6 consecutive months. In the most recent published data, 76.88 million ounces of registered silver are sitting against 575.5 million ounces of outstanding paper obligations. That is a 13.4% coverage ratio. Here is how to think about that number in plain language. Imagine a bank that holds 13 cents of real, withdrawable cash for every single dollar it has promised its depositors. That is structurally what the COMEX silver market looks like right now. And yet, the paper price derived from that market is the number your financial news channel flashes across the screen as the definitive price of silver. This is where it gets interesting, and this is the question nobody in the mainstream press seems willing to ask out loud. Who has the financial capacity to absorb billions of dollars worth of physical silver month after month for a year and a half without using leverage? Who is doing this? And critically, why are they doing it during a period when the paper price has been trending lower? The answers to those questions are not speculative. They are documented. They are confirmed by customs data, Bloomberg reporting, and exchange warehouse reports that are publicly available to anyone willing to look. And we are going to walk through all of it right now, section by section. Stay with me. Let's talk about China, because this is where the data becomes genuinely extraordinary. And I want to be precise about every number here, because every number is verifiable. In March 2026, China imported 836 metric tons of silver in a single month. The 10-year seasonal average for Chinese silver imports in March is 306 tons. That means China imported 2.7 times its historical average in a single calendar month. This was confirmed by Chinese customs officials and reported by Bloomberg on April 20th, 2026. It is, by the record books, the largest monthly silver import figure China has ever recorded. But the more significant story is not the raw number. It's the directional reversal underneath it. In 2025, China was a net exporter of silver, shipping approximately 5,100 tons out of the country annually. Within the span of roughly 12 months, China has transformed from the world's largest silver exporter into a country importing silver at a pace that has no historical precedent in its own data. The January and February 2026 figures alone, 790 tons across 2 months, represent an 8-year high for any consecutive 2-month window. The entire first quarter of 2026 is tracking as the highest silver import quarter in China's recorded history. However, there is a layer beneath even those numbers that makes the picture more specific. In January 2026, China formally reclassified silver as a strategic material. Silver exports were restricted to a list of only 44 government-authorized companies. Almost immediately, the domestic Chinese silver price began trading at a premium of 12 to 17% above the international benchmark price, the same price your trading platform shows you. Think carefully about what that premium means. The world's largest silver-consuming nation, also the second largest silver producer on the planet, is now paying significantly more for silver than the globally quoted paper price suggests silver is worth. Which price reflects genuine market reality more accurately? The paper price generated by a market with a 13.4% physical coverage ratio? Or the price that the world's single largest buyer is actually paying in the open market? This is not retail-level speculation. This is sovereign-scale accumulation happening at precisely the moment the paper price was being driven downward by mechanisms we are going to examine in a moment. The timing is not coincidental. The scale is not accidental. And the entity doing the accumulating has both the patience and the balance sheet to absorb physical metal at whatever pace the paper market allows. But there's a catch. And understanding the catch is what separates the people who see this clearly from the people who only see the number on the screen. Let me show you exactly how the paper price gets managed lower, even when the physical picture looks like this. Between December 2025 and January 2026, margin requirements for COMEX silver futures contracts were raised by approximately 300% over a 6-week window. On December 1st, holding a single silver futures contract required roughly $15,000 in posted margin. 6 weeks later, that figure had risen to approximately $54,000. A trader holding 50 contracts at the start of December needed $750,000 in their margin account. 6 weeks on, that same position required $2.7 million just to stay open. Anyone unable to fund the margin call was automatically liquidated, forced to sell, regardless of their view on the market. Simultaneously, the January ETF rebalancing window was active. Large silver ETFs operate under prospectus rules that require portfolio rebalancing at the start of each calendar year. The positions accumulated across the prior months are systematically unwound, creating a structural wave of selling that hits the market in the first 2 weeks of January, independent of what the underlying fundamentals indicate. The Bank for International Settlements, in published commentary, noted that the January correction was structural rather than fundamental in character. What you had was forced speculative liquidation through margin escalation, combined with mechanical ETF rebalancing, while sovereign-level physical buyers were standing for delivery at the exact prices the paper mechanism was creating. In a single week during January 2026, 33.45 million ounces were withdrawn from COMEX registered inventory, roughly 26% of the entire deliverable pool disappearing in 7 trading days. The physical buyer said thank you, took delivery at the paper-suppressed price and drove it away in trucks. That is not a commodity being priced by free market discovery. That is a mechanism that systematically transfers physical silver from leveraged paper holders to well-capitalized physical accumulators. Now let's pull back to the macro layer, because this is where the silver story connects to something much larger. In fiscal year 2024, the United States government spent $1.13 trillion servicing interest on its national debt, exceeding the entire U.S. defense budget of $954 billion for the same period. For the first time in American history, debt service costs outpaced defense spending. The Congressional Budget Office, nonpartisan, publicly published, confirmed this milestone. Interest payments on U.S. national debt have risen 175% since 2020, from $345 billion to over $113 trillion in 4 years. The same CBO projects that by 2031, 100% of U.S. tax revenue will be consumed by mandatory entitlement obligations and interest payments. Everything else, defense, infrastructure, education, funded entirely through additional borrowing. Historians refer to this dynamic as Ferguson's Law, the principle that any major power spending more on debt service than on security is structurally at risk of declining influence. The United States has now crossed that threshold, and that crossing matters for every hard asset on the planet. There are only 3 historically documented paths out of a debt burden of this magnitude. You inflate your way through it by debasing the currency. You formally default, or you generate your way out through a manufacturing renaissance. The U.S. manufacturing base has been significantly offshored over the last 3 decades. A formal default on Treasury obligations would immediately destabilize the global financial architecture. That leaves currency debasement as the path of least resistance, and the institutional world knows it. Former Treasury Secretary Hank Paulson publicly called for U.S. authorities to develop an emergency contingency plan for a potential collapse in demand for U.S. Treasuries. His words on the record, "The plan needs to exist before the crisis arrives, because when it arrives, it will move fast." This is not an internet commentator. This is the former head of the U.S. Treasury Department describing a scenario that warrants pre-crisis preparation. Bank of America's chief analyst has publicly cited a silver target range for this cycle. Morgan Stanley's chief investment officer declared the 60-40 portfolio model structurally obsolete, recommending a reallocation that includes 20% in precious metals. Jeffrey Gundlach, the bond market's most respected voice, has stated publicly that a 25% allocation to gold and silver is not overweight. These are not fringe perspectives. These are the largest, most credentialed asset managers on earth, making these statements on the record. And the physical silver holder navigating the paper volatility of recent months is positioned exactly where these institutions are directing their most sophisticated clients. So here are the 4 signals I am watching right now on SilverDispatch. First, the COMEX coverage ratio. When registered inventory divided by open interest approaches a level where a delivery event cannot be absorbed, that is the warning signal. CME publishes daily warehouse reports. Pull them yourself. Second, the China premium. If domestic Chinese silver prices are running 12 to 17% above the international benchmark, the physical market is disagreeing with the paper price loudly. Third, the Treasury yield behavior. If equity markets and bond markets fall simultaneously, Capital is leaving both, and it needs somewhere to land. Fourth, the gold-silver ratio, at its current historically elevated level, every comparable period in modern market history has been followed by silver dramatically outperforming gold. Wayne Gretzky was once asked how he dominated a game built on speed. He said he skated to where the puck was going, not where it was. The 18 months of delivery data, the 836-ton China import month, the 13.4% coverage ratio, the former Treasury Secretary preparing contingency plans, that is where the puck is going. The paper price is where it currently sits. I'm OG Peter. This is SilverDispatch. All sources are linked in the description. Pull everyone and verify independently. Hit like if the four-signal framework gave you a cleaner lens on this market. Subscribe with notifications on and tell me in the comments, physical, PSLV, SLV, or something else entirely. And which number from today surprised you most? This is not financial advice. Everything here is educational analysis based on publicly available data. See you in the next one.